Hello, everyone. Good morning, good afternoon, good evening, wherever you are based in the world. I'm Anish Lal. This is the Black Bull Markets webinar. Today, we're going to discuss all things moving averages. Um, Moving averages is actually quite a personal favorite indicator of mine, and it's a delight to speak to you about it as we veer on the holiday season. Okay, so we're going to discuss all things moving averages today. Moving averages is actually quite a personal favorite topic of mine. I like to use it as an indicator, trading trends on the long term and short term trends. It's quite a great indicator if you're looking at swing trading, or even, to be honest, depending on the type of moving average, a shorter term opportunity confirmation as well. So just to confirm again, if you have any questions or want to chat, feel free to use the options in the webinar window. Now, let's just, I guess, run through some markets as we're on the gold chart, at least. Of course, gold's been on quite the roller coaster over the last month. Extreme amounts of volatility. Of course, you've had the Federal Reserve play a huge part behind the fundamental drive in gold. Of course, it's kind of ended up where it closed off the month, actually. 2040, you had a bit of a fall from those highs at 2132. Of course, that was the 2135, the all-time high in gold, which was quite a phenomenal reset in terms of finding new highs. And then we had a steady fall past $2,000 an ounce, and now it's picked up that $2,000 an ounce mark, finding some sort of resistance around this 2040 as the markets start to slow down a little bit. Still a decent amount of volatility, but as you can see on the smaller ticks, you've got 2 more days until Christmas Day where the markets are closed, and then you do tend to get a lot of traders leave their desk and volatility naturally slows down. Back to the topic at hand, moving averages. So let's get started. Now, it's important to note that there are 2 different types of moving averages. We're going to actually stay on this gold chart just so we can get a good idea of we'll just remove this, get a good idea of trending markets and how we could possibly pick some entry levels. Now, there are 2 types of moving average methods. You've got a simple moving average method. You've got an exponential moving average method. Those are the 2 common ones. Smooth and linear weighted are others, which are less commonly used, but we'll stick to going through these 2 examples. Now, the simple moving average is based off the price movement, whereas the exponential moving average is actually based off the weight of the data that's involved in the prices. The difference between the 2 means that the exponential moving averages are a lot closer to price action, and in fact, it's used more commonly with traders who are more short-term traders looking at lower periods of moving averages. The higher period, or the higher the period of moving average, the more long-term trend you are identifying. For example, a 200-day moving average, exponential moving average, will just for charting purposes, we'll put the line quite thick. You'll see that it plots prices, of course, of 200 days. And as you can see, if we go to a higher time frame, there's not much movement, just depending on how you're looking at this. But you're going back a couple of years now, it's got a steady uptrend, but 200 days doesn't really give you the. Should be able to put it on all time frames. Doesn't really give you a huge amount of information. You've got key support areas, I guess you could identify, or key moving average areas that are plotted around this line. The closest we've ever got to it was 1811, and that was, of course, a key support area which broke higher earlier on this year, and we've been on a ramp ever since. So I guess if you're looking for some sort of confirmation, am I in a long-term trend? that is bullish on gold? The answer would be yes. If we're basing it off that 200-day moving average going from February 2021. So that's the first part that's important to note about moving averages, is looking at the time frames that you want to place them on. Now, of course, every moving average that you place on a different time frame will plot a different price. If we put something a bit more acceptable on, like a 50-day EMA, here we have a better visualization of a price chart graph that moving average has been plotted on, where we can identify a bullish trend. And of course, you've had two occasions in the last couple of months where we've hit the 50-day, especially breaking out from that sideways market where, if you remember, cast your mind back to the beginning of the year, gold was pretty much stuck in this trend here for a while between 1969 1930. There's a range, rather, the zone broke out to the downside initially, broke below the 50-day moving average, and then came back up to attack it. Now, is that a short opportunity? Potentially. That could give you a signal that you're below your moving average. Potentially you're going against the overall trend. If you're looking to trade with the trend, then you're looking for potential support opportunities to enter. On the other side, you can use moving averages as a support reading too. Some people like to use the moving average, especially on the daily chart, as an indicator to trend shifts or trend changes, trend rotations. For example, 1937, around that, you've got a wick below. Even if we zoom in into the chart, you can see it quite nicely here. 2 wicks below, 2 body of the candles above the moving average. Similar here, you've got a body close above the moving average, wicks below, which mean rejection, buy, rejection, buy. Again, here you've got a bit of a doji forming that indicated the trend shift. So these candlesticks and the moving averages matching up nicely indicated solid buying opportunities on those two respective days, of 13th of December and also the 13th of November, ironically 13th of every month. If you've bought it, of course, to the next moving average top, that was 2%, 411 pips. So now, again, we, in terms of a trading strategy, the way I personally like to use moving averages is I would put 2 moving averages on my chart. I'd have a 50-day and also a 20-day. Now, this is something which can be incorporated into the moving average crossover strategy. It's what it's commonly known as. And the moving average crossover strategy essentially looks at key inflection points in the market. This is a daily chart that we're stuck on here first. We can even skip that to the 4 hours, zoom out a bit, and we get a bit more of a graphical representation of this. The 20-day represents, of course, 20 days of price movement. 50 days would be slightly lagging that. Now, the crossover points are quite important because, again, if you're looking to trade with the trend, and as you can see, gold it's been quite of a trending market over the last 3 or 4 months, especially the move to the upside on the longer term time frames, that is. And if you're swing trading, it's a beautiful strategy to start incorporating. Just going back here in this first crossover as an example, to keep it very simple, sweet, your blue line is your 21-day, your red line's your 50. Your blue line crosses above your red line, 21 above the 50, that is a buy signal. And the idea is you're long the market until it crosses over again. Now, say we've done this from October to current date. Now let's just back test this strategy. On this particular occasion, 7% price movement you would have captured in gold, 1,314 pips, there and thereabouts. Flip side, your 20-day moving average moves below your 50-day. That's your sell signal. You take that and you go all the way down, you would have captured 1.12% of a negative move in gold. That's 222 pips. So we're looking at this, you're already at 1,500 pips. Now you take your next buy signal and you take it to the next close. You've captured a 3.5% move in gold. That's 687 pips. So we're looking about over 2,000 pips here from 1, 2, 3 trades in the space of 3 months. Again, we go down 211 pips. So we're looking at 2,200 odd pips. And now we're in a buy signal. So if you bought gold here, you're looking for the next close of those moving averages. This is the most simple strategy you can implement, sticking to one time frame, one asset, looking at the moving average crossover, trading small. That's the important thing, right? Because swaps on gold long especially could eat you up if you're trading high. I think the average for $1 now is $4. So it's one thing to consider. There is a cost to this strategy. You also do get paid for holding gold short, so that could balance out your net swap cost. However, if you keep your trade size small, it's quite profitable. Even if you're trading $1 a pip, that's $2,200 that you've made with respective stop losses, say minus swap costs. And if we forecast swap costs, you're looking at about maybe $300 or $400 there. So net, you're still up for $1,500, $1,600 in terms of a net profit. Now, that's quite incredible considering you're just following a basic strategy. You've taken your emotions out of the trade. You're looking at a moving average crossover, and you're sticking to a strategy that has been back tested, tried and tested, and in trending markets works extremely well. Now, if you've got sideways markets that hardly move or are sort of range bound more or less, this strategy might not work as effective as it does. Now, we picked the 4-hour time frame. The larger the time frame, the less amount of crossovers you would get, because if we looked at the same period, right? If you looked at from October, you've got just one crossover. So you'd be in a long position at the moment. And again, if you're mark to market price, you would be up about 1,300 pips. So if you even go down to the 1-hour chart, now it gets a bit stickier on lower time frames. It still works pretty well, but overall, I mean, you'd want to look at the 4-hour or the daily. In my opinion, for this strategy, this moving average crossover strategy is built for swing traders. If you have less patience with your strategy, it might not be right. Might not be the right strategy for you. So that is on gold's 4-hour chart, backtesting our moving average crossover strategy. Even if we go back into September, you're capturing pips here, 756 again, 1,300. Now this is a beautiful, simple strategy. Let's apply it to some FX charts now. So euro dollar, 4-hour time frame. We're going back again, start middle of October. As you can see, this here is a great example of let's just get a rectangle around it, a choppy market. Choppy market means you're going to get a moving average crossover divergence like several times within a short space of time. Now, what do? You either don't trade choppy markets, or what you do is you could continue to use the moving average crossover strategy and essentially ride out the choppy market. Perhaps you might have to take some losses on those trades, but you're waiting for that key breakout. And when do you know when a breakout is? Well, it's impossible to know that. So you're really sticking to your strategy, sticking to your guns, looking for smaller pips here. Breakout, bang, on the breakout, 1st of November. Yeah, and your next crossover down was the 1st of December. So for the whole month of November, you would have been long euro, and you would have closed it upon the next crossover, and that's 340 pips. 3% in gold, and the swaps on gold long are not that bad. So not as bad as gold, at least. I guess if you want to check it out, you can go to the specs, and you're looking at it's quite bad. Okay, so I mean, in dollar terms on the euros, you're probably looking at about $7 a night holding that for one lot. However, 10 cents a point, would be, of course, 7 cents. $1 will be 70 cents. So even if that you've got 330 pips there, say that's $1 a point, it's $330. You minus your swap cost, which say is 70 cents a day, times 20 trading days, you're looking at $14 of total cost of swap. So you're still relatively net in a decent amount of profit, even by following this strategy. The idea is moving average crossover, stick to it, stick to one time frame. If you're looking for more opportunities, you go to lower time frames. If you're looking for a sound amount of opportunities in trending markets, my opinion would be to stick with the 4-hour time frame. Look for those consistent crossovers, buy and sell when you see them, and essentially keep the trade size small. I would also look at using a stop loss on this type of strategy, because worst case, you always want to protect yourself to the downside. It's never a good idea to trade without a stop loss. You put yourself in the free fall zone, and markets and put your account at risk. Markets are they are extremely unconsiderate of your feelings, and they just don't care. Relentless, ruthless. Trending market of the year is one of the most beautiful sells on the yen. If you've been long dollar yen, you've been in the money this year. And you can see though the moving average crossover. This is a daily chart. We're now in a bear trend, so you're looking at shorter term opportunities. But again, you can see steady buys. 1 buy, 2 buy, 3 buys, and then capturing, almost again another 1,000 pips to the upside there. So capturing all that move, and this is the beauty of moving averages. It can be applied across any asset, quite honestly, as long as you've got a historical base of charting data for it to read off of. The exponential moving average will hug your weighted data set and give you a real sound reading of the chart. I like to use it on the more volatile pairs, gold, euro dollar. If I'm switching my style up into swing trading, if I'm looking at changes of trends, this is the ideal indicator that you can use. And essentially, it's quite powerful if you are consistent with it. So that was moving averages in 25 minutes. Within 25 minutes, that is my strategy on moving averages. It's quite simple, quite straightforward. I'm here now to take your questions. Please do use the chat function, or if you have questions, here to help. Of course, this video itself will be posted on our YouTube channel after this recording has ended. You'll be able to access this, and I guess we hope you've enjoyed the video. I wish everyone a very happy Christmas, very happy New Year, and all the best from us at Black Bull Markets. I'll leave my email in the chat thread. If you have any questions, feel free to follow up with me personally, and happy to share thoughts and love. All the best.